A very warm welcome to the FactSet Insight podcast. I'm Guy Adami, always joined by Dan Nathan. We've been asked to join the great John Butters. He's the senior earnings analyst at FactSet. So, Dan, in a way, we're commandeering his podcast.
Well, by the way, these guys are our fine partners. They are the official data partners of Risk Reversal. So we are always very honored to be here, John. Again, we've said this again and again on our Market Call podcast. I mean, your work is invaluable into earnings season, throughout earnings season, and reviewing earnings season. So here we are. We're a little more than midway through it. So thanks for having us, John.
Yeah, and thank you guys for hosting. Always appreciate you guys taking the time to help host our podcast for the midseason earnings update. I think we missed this last quarter because you guys were graciously helping us out at the FactSet Focus Conference. So good to be back talking earnings. Thank you guys for doing that, and thank you for hosting the podcast today.
Absolutely. So here we are, early August. We're about, as you said, 60% through earnings of the S&P 500. Let's talk about it because the earnings growth rate is surprising me. I don't think a lot of people realize what we're seeing right before our very eyes.
Yeah, so let's talk about the setup coming this earnings season. So this chart shows a time series of the Q2 earnings growth rate for the S&P 500 from the end of March through this past Friday. And so if you look at the start of the quarter, analysts were looking for about 19% growth. And that estimate actually increased during the quarter and finished the quarter at 23%. We actually saw analysts increasing their earnings expectations during the quarter. A lot of upward revisions to estimates for companies in the energy sector and the tech sector. And again, that's rare. Usually those numbers come down as we go through the quarter. And since the end of the quarter through this portion of the earnings season, that growth rate has jumped up to 47.4%. And so a couple reasons for that. One, we're seeing a lot of we are seeing a lot of companies beat the estimates. 86% of companies overall have beaten the estimates. And we have seen a few high profile companies beat the estimates, which we'll talk about in a little more perspective in the next slide. But if we finish at 47.4%, that'd be the highest growth rate we've seen going back to 2021. So very strong growth for the S&P 500 so far.
Hey, John, that 86% beating is really astounding. You keep hearing this sort of commentary in the markets about how they're broadening out away from the concentration, right? And I know we're going to talk about a little bit of the concentration, but when you see this sort of hockey stick action in earnings growth, I mean, it's not something that I've seen too frequently. Maybe, yes, when it's coming off a low base after, let's say we saw that in COVID, and we've seen it in other periods where you've seen a lot of market volatility. But just kind of help put that in some context, because coming into 24, coming into 25, we're expecting low teens percentage gains year over year, and it just keeps getting ratcheted higher in 2026. And then also, to your point, we're seeing earnings revisions throughout the quarter as it's going on, and now you see this hockey stick action for Q2.
Yeah, I think a lot of the improvement has been in both the tech sector and the energy sector. That's where we've really seen the upward revisions these last couple of quarters and coming to set. That's a big part of it as well. And if we can move on to the next slide, we can probably get into this in a little bit more detail on what's really driving that increase. So the chart we're showing here, these are the top 5 contributors to earnings growth for the S&P 500 for the quarter. And the two that I really want to point out are Alphabet and Amazon, as they both reported significant earnings surprises that were well above expectations. So for Alphabet, they reported $9.11 versus expectations for about $2.85 per share. And Amazon reported $5.75 versus expectations of about $1.82. And so, however, it's important to note that for both those companies, the majority of analysts are giving us estimates on a GAAP basis. So we use the GAAP numbers in our growth rate. And the GAAP numbers for both those companies included large gains in their other income related to unrealized investment gains to their AI investments. And that's one of the reasons you're seeing these huge increases in earnings for both Alphabet and Amazon.com this quarter. As a matter of fact, those two companies alone accounted for 80% of that increase in the growth rate. So that jumped from 47% from 23%, 80% of that due to Alphabet and Amazon.com. So, and this, might reignite that debate versus GAAP versus non-GAAP earnings. Because again, we're using GAAP for both Alphabet and Amazon.com. You look at a company like Microsoft, they had much smaller gains, but they do report a non-GAAP number excluding them, and that's what the analysts go with. They use the non-GAAP. But because the majority of analysts use GAAP, these companies only report GAAP. We use the GAAP numbers in our expectations, and that's why you're seeing such a significant increase in the growth rate. But I will point out that even excluding those two companies, it's been a pretty solid earnings season, and we'll go into that in the next two charts and slides. But But for now, these two companies are two of the main drivers of that substantial increase in growth.
Yeah, and Micron at the top of the list. I mean, that should not surprise anybody, given what they were a year ago and what people are looking at now. But the one that, and before we get to the next slide, the one that sort of fascinates me, because typically these names don't make it into your work, is Chevron right in the middle. And maybe it makes sense in the backdrop of what's going on with crude oil and those types of things. But the jump in earnings in an energy stock, that to me is like, I didn't see this coming, John.
Yeah, and it's interesting. And those numbers came up during the quarter. Chevron was one of the companies in energy sectors that saw their numbers come up. So a lot of that obviously tied to the price of oil. So if you look at the price of oil, the average price during the second quarter of 2026 was 45% above the average price in 2020, in second quarter of 2025. And that's helped to really drive the earnings of not only Chevron, Exxon, but a lot of the companies in the energy sector. And I know when we do the sector breakdown, we can talk a little bit more about that in detail. But yeah, again, price of oil really helping to increase in the price of oil, really helping to drive the earnings of Chevron and other companies in that sector.
Yeah, and John, one of the big drivers, obviously, of earnings growth are margins, and this is something that you kept on hearing in 2025. Well, we're at peak margins for this industry, or peak margins for that. Well, that clearly hasn't been the case, and so kind of help us think a little bit about how the margin picture is driving a lot of these gains. Oftentimes in the markets, people look, well, we're just seeing multiple expansion. Well, you see multiple expansion when you see margins expanding.
Yeah, and so on this slide here, this is a chart that's breaking down again some of the metrics where we're seeing the impact of Alphabet and Amazon really driving the headline number up. But the takeaway here is that even if you take those companies out, we're still seeing a very solid earnings season. And Dan, that relates to net profit margins as well. So let me just run through these numbers quickly. So we already talked about the earnings growth rate, 47.4% overall for the S&P 500. But take out Alphabet and Amazon, that drops down to 28.8%. But even at 28.8%, that matches the previous quarter. That'll be the second straight quarter of growth above 25%. So even taking, the higher earnings because of those gains out, you're still seeing a solid quarter. And that's almost double the 5-year average of 15.2%. And if we look at the earnings surprise, this is the magnitude of the beats, right? Obviously, again, that number skewed higher to 31.4% because of Alphabet and Amazon. Take them out, it drops down to 9.2%. That's still above the 5-year average of 7%. And then, Dan, to your point on profit margins, again, the headline number, 16.7%, again, boosted by those higher earnings from Alphabet and Amazon. But take those two companies out, you're at 14.7%. That would still be the second highest net profit margin reported by the index going back to 2009, which is the extent of our data. And that's just slightly below where we were last quarter at 14.8%, and again, above the 5-year average. So my kind of main takeaway point here is that even though we're seeing a lot of these headline numbers for earnings skewed because of the higher numbers of Alphabet and Amazon, take those companies out, you're still seeing solid earnings growth, companies beating by solid margins, and really solid profit margins overall.
I talked about Chevron a few minutes ago, and the next slide suggests that, maybe it's not as far-fetched as I thought, because energy at the top of the sector list in terms of earnings growth. So break this down.
Yeah, so if you look at the sectors, and again, this sort of is reinforcing that point that even taking those two companies out, you're seeing fairly broad-based growth. So overall, 10 of the 11 sectors are reporting year-over-year growth. 8 of the 10 are reporting double-digit growth. So I'll run through some quick bullet points on each of these sectors. So energy, we've touched on that already, leading the pack at 135% growth. Higher oil prices, we touched on that earlier. 3 of the 5 sub-industries in that sector reporting growth over 100%. Communication services, we already touched on that, 110%. Almost all of that is Alphabet. Take Alphabet out, that sector is actually reporting a decline in earnings. Similar with consumer discretionary, 91% growth. They're the third highest. Take Amazon out, that drops down to 6%. But now we get into some of these other sectors that aren't impacted by them. Technology, 69% growth reported. All 6 industries reporting growth, led by the semis. We talked about Micron Technology and NVIDIA both leading the growth there. Materials, 43% growth. All 4 industries reporting growth. Chemicals and metals and mining, strength there. Financials, 20%. Strength from the banks and capital markets. Utilities, 14. All 5 industries reporting growth. And industrials, I know, Guy, this is one of your favorite. 14% growth. They're actually reporting the 8th highest growth at 14%. Strength across the board there. 10 of the 12 industries reporting growth. A large number reporting double-digit growth. Aerospace and defense. Machinery, we had Caterpillar earlier, or yesterday rather, not even included these numbers, helping to boost growth. So again, fairly broad-based growth, even if you take out the impact of both Alphabet and Amazon.
Yeah, John, on that impact of Alphabet and Amazon, and I've seen you quoted in the press too, and that whole gap versus non-gap argument. I mean, I think a lot of investors, if you're not an institutional investor who reads your work, every week, that sort of thing, and you're not kind of tracking this sort of data, it can be a bit confusing. And so I'm just curious, when you go from that 47% down to 22% on those gains that those companies have registered in their investments, whether it was Anthropic or OpenAI or SpaceX. I think those are a few of them that we've been seeing pretty frequently over the last year or so. What does it do to psychology around earnings when it goes the other way? Like, generally in a lot of these private companies, you don't see markdowns. But in 2022, we did see that sort of stuff. So how do investors, what's some of the feedback that you get if it does go the opposite way? Because I know that a lot of investors who track this stuff and they focus on gap versus non-gap, they probably don't put a lot of credence into it, but the headlines are pretty dramatic.
Yeah, and to your point, I believe it was back in 2022. If you look at Magnificent Seven earnings, those are one of the years earnings were down, and some of the reasons for that was some of these investments not doing as well. I think one thing that's been interesting this earnings season, and I didn't touch upon it here in the slides, is some of the market reaction to the earnings surprises. So it is interesting to note that this earnings season we've seen a much or below average positive response to positive surprises than we typically see. So, for example, companies that have reported positive surprises have seen just a 0.2% increase in price 2 days before through 2 days after. If you look at the 5-year average, that's 1%. So it could be something, and I would probably defer more to you guys on this one. The market could be factoring that in when it's looking at these, sort of these results, and maybe factoring that in when it's, sort of seeing the results afterwards. Because if you look at it, and we'll get into this on one of the later sides, guidance and revisions have actually been pretty good looking forward. So I don't think the negative reaction be related to that. So, but I'll defer to both of you on that in terms of some of the price reactions, but definitely less positive this quarter than we've seen in recent quarters.
Yeah, that slide to me, going through it, just pulling some stuff out. I'm surprised by the underperformance of healthcare, but in retrospect, maybe I shouldn't be as surprised because that's on the far end of the graph. And I would have thought financials would be better as well. But with that said, I mean, 20%, it's not bad given the context of what financials do historically. So just a fascinating chart, and the numbers sort of leap out. The next slide, though, John, is again something I want to talk about because it's the topics that companies cite during earnings call. And I think a lot of people sort of know a lot of them, AI being at the top of the list, but there's some other things in there as well.
Yeah, so we try to track kind of key terms that come up during the earnings calls over the last few earnings seasons. So this chart shows a comparison of the percentage of companies that have talked about that so far through Q2 versus Q1. And I think what's interesting here is we're not really seeing much change in terms of AI, inflation, or tariffs. Roughly the same percentage of companies are talking about those now versus a year ago, right? So for AI, it's roughly 67%, inflation 44%, tariffs roughly 35%. But look at a few other terms: uncertainty, Middle East, and oil. And we have seen a significant drawback in the number of companies talking about those on earnings calls this time around versus last quarter. So for uncertainty, it's been 32% this quarter versus 45% last quarter. Middle East, 30% this quarter versus 45% last quarter. Oil, 20% this quarter versus 31% last quarter. So some of this could be related to, and again, I'll hear you guys' opinion on this. We have seen the market go up the last couple of days, and it seems like some commentary has been, there's been some thoughts that we might get some resolution in the Middle East. We'll see. But certainly from a company perspective, we are seeing fewer companies talking about, some of the terms related to that oil and Middle East this quarter versus last quarter.
Yeah, and those are sorts of things where, we have a lot of analysts that we speak to frequently, and we try to look at the transcripts of as many earnings calls as we can. Sometimes it's hard because we're breaking down, a lot of these earnings as they're happening while we're on the set of Fast Money, that sort of thing. But, AI is the one over the last, let's call it 3 years, that I think is the one that a lot of market participants and investors have reacted to. And like, for instance, over the last couple of quarters, we've seen companies that don't have, like, whether it's, let's say, in the semiconductor business, they don't have a lot of exposure, right? And all of a sudden you would go from, Q1 to Q2, where if you were doing this exact sort of data, there was 4 mentions in Q1 and 15 mentions in Q2, and there was a reaction, right, to the stock moving one way or the other. And to me, that actually speaks to a level of FOMO. Now, the other one is it relates to inflation. That's something that we've been hearing about for 3 years, and tariffs for let's call it 5 or 6 quarters, that sort of thing. And Middle East, this has just been going on for a few quarters, and they just haven't been moving the stocks much because you're expecting it to be in there. But one of the things that actually turned me around a little bit, and actually got me sort of bearish on some of these calls and the way in which managements were discussing, it really was the AI one. And we'd sit there and say, well, this is a company that has 5% of their revenues are AI, and they might be growing off a low base. So I love tracking this sort of data. And after, a quarter, 2, 3, you can start dismissing some of the uncertainty around some of those terms. But again, I bring this up all the time with your data. It's really helpful to put some things in context over the course of a quarter.
Yeah, and it's interesting, when we talk about AI, and I think we've talked about this before, it's just amazing the spike you've seen. This is something, I think I've been tracking this for 3 or 4 years now. And, you start off with a very low number of companies, and we're now, at 67%, that puts you, well over 350 companies in the index every quarter, at least talking about AI in some capacity in their earnings calls. And again, we're on pace right now. We'll see if that number finishes higher when it's all said and done. You talk about your sort of hockey stick chart. It just continues to spike up. More and more companies talking about it every quarter.
I guess we'll finish sort of where we started, year-over-year earnings growth in the S&P 500.
Yeah, so this is looking at expectations going forward. So, I think a couple of key takeaways here. So one, if we look at the second half of 2026, you're still looking for really solid earnings growth, 27% in Q3, 25% in Q4. As we go into 2027, I would say Q2 is sort of an aberration because that number is way down because of the spike in the Q2 earnings growth rate. That's the base going up. But we are looking for a little bit slower growth in the first half of 2027, but still 16, 17%. The other key takeaway here, and again, this is probably the more important one, expectations are still going up. If we look at, 4 of those 5 quarters going forward, the growth rate's higher today than it was back on June 30th. So again, there's still a lot of optimism out there for continued earnings growth, and analysts are continuing in aggregate to raise their estimates overall. It is interesting if we look at the forward PE ratio. It's improved a little bit over the last couple of days, but because of the rise in the market. But we went back last week, we were actually below the 5-year average briefly for about a week, which is unheard of. The 5-year average is about 19.9. We hadn't been there in a long, long time. Now we're back above it again. So certainly very optimistic outlook for expectations going forward. And again, we'll watch the guidance, we'll watch the company commentary to see if there's any changes in these trends as we go through the final 40% of earnings season.
Yeah, that's a great point that you make, because we did talk about that Alphabet and Amazon contribution in many instances over the course of this podcast. And when you think about how those stocks have rallied and the beats that they put up, it kind of speaks to what you're saying as far as the multiple is concerned. Well, John, we are honored. We are honored to be here with you on your podcast, and we just appreciate all the data that we get to get smarter on, whether it's on the Risk Reversal podcast or the Market Call, and obviously on Fast Money, because we try to quote your work as often as possible, because you just make us look smarter. So thanks so much, John, for having us.
Oh, we appreciate that. And thank you guys as always for hosting. Thank you guys for the opportunities for me to come on your podcast. Really appreciate it on Risk Reversal, and looking forward to doing it again next earnings season.
Thank you, John.